Today, let's look at another clip from Buffett's 1998 speech at the University of Florida. The theme is long-term holding, or to put it another way, the wisdom of not doing too much. As with previous videos, let me say this first. Buffett's ideas are not only useful for investors, they also offer real insight for ordinary people, entrepreneurs, and young people. In this Q&A, a student asked him, "You've chosen to live in Omaha, a relatively remote city. For an investor, that's an unusual choice. What advantages does that give you compared to staying on Wall Street?" Buffett's answer led to a deep insight into the entire financial industry.
The best way to get to think about investments is to be in a room with no one else and just think. And if that doesn't work, nothing else is going to work. And the disadvantage of being in any kind of a market type environment on Wall Street would be the extreme is that you get overstimulated. You think you have to do something every day. I mean, the Canver family paid $2,000 for this company, and that you don't have to do much else if you pick one of those. And the trick then is not to do anything else. Even not to sell it in 1919, which the family did later on. So what you're looking for is some way to get one good idea a year, and then ride it to its full potential. And that's very hard to do in an environment where people are shouting prices back and forth every 5 minutes and shoving reports under your nose and all that. Because Wall Street makes its money on activity. You make your money on inactivity. I mean, if everybody in this room trades their portfolio around every day with every other person, you're all going to end up broke, and the intermediary is going to end up with all the money. On the other hand, if you all own stock in a group of average businesses and just sit here for the next 50 years, you'll end up with a fair amount of money, and your broker will be broke. He's like a doctor who gets paid on how often he gets you to change pills. I mean, basically. If he gives you one pill and it cures you the rest of your life, he's got one sale, one transaction, and that's it. But if he can convince you that changing pills every day is the way to great health, it'll be great for him and the prescriptionists, and you'll be out a lot of money, and you won't be any healthier. You'll be a lot worse off financially. So you want to stay away from any environment that stimulates activity. And Wall Street would have the effect of doing that.
One of the sharpest lines is when he compares money managers to a doctor who keeps changing your prescription. Accurate and brutal. In fact, there was already a famous joke on Wall Street in the early 20th century. A visitor attends a grand party hosted by financiers in New York. Walking by the harbor, people point and say, "That's the yacht of this fund manager. That's the yacht of that banker." So the visitor asks an awkward question: where are the customers' yachts? That line later became the title of a best-selling investment book. The point was simple. The people managing your money got rich, but you didn't. Doesn't that still feel familiar today? I think all of us have had similar experiences in life. Whenever you need a professional to help you, that person has interests of their own, and when their interests conflict with yours, their ethics are put to the test. In economics, this is called the agency problem. When you buy clothes, a phone, or an insurance policy, the salesperson may not recommend what is best for you. They recommend what gives them the highest margin. When you renovate your house, the designer may not choose the most cost-effective materials. They choose what gives them the biggest commission. A company's management team may allocate more benefits to itself rather than returning more to shareholders. The agency problem shows up most vividly in finance, especially in asset management. Because the information asymmetry is greater, the room for manipulation is larger, and the moral cost is lower. So for Wall Street fund managers, even a small drop in ethical standards can lead to a huge increase in personal profits. In his 2005 letter to shareholders, Buffett used a thought experiment to revisit this topic. Imagine all listed companies in the United States were owned by one single family. Every family member's wealth grows at the same rate. They simply sit back and collect dividends. Then along comes a group of smooth-talking, clever people. They approach a few family members and say, "Want to make more money than your brothers? Simple. Just buy some shares from him, sell some shares back to him. I'll be the middleman. You just pay me a small commission." Then a second group arrives, worried about which stocks to buy. "I'm a professional analyst. I'll pick stocks and time the market. Just pay me a consulting fee." Then a third group shows up. "With so many analysts out there, how do you know who to trust? I'll help you choose analysts. I even have a ranking system. Pick from my list." Then a fourth group. Forget all the hassle. Just give your money to me. I'll handle everything. Just pay a small management fee. Then the government and banks arrive. With all this trading, you need legal protection. You need banks to hold the funds. The government will certify your contracts for a small tax. The banks will charge a custody fee. That's reasonable, right? Then the fifth, sixth, and seventh groups appear. Apps so you can trade in real time, media platforms to share predictions, and people claiming they can do hedging, quant trading, futures, and all kinds of advanced strategies. Do you see what happened? The moment you want to make more than your brother, it's like opening Pandora's box. One desire leads to the next and the next. The whole financial industry explodes like a living organism. It becomes a giant carnival, and those family members get completely pulled in. But through all of this, what is the one real truth? Think back to the agency problem. The only thing that really happened, wealth kept transferring from the principals to the agents. No new wealth was created. Buffett used a physics analogy. All this activity is like friction loss in mechanics. It creates no value. It only destroys value. And in the United States, those friction costs account for roughly 20% of all listed companies' earnings. So Buffett joked that Newton might have discovered a fourth law. For investors as a whole, more motion leads to lower returns. Higher trading frequency is a structural disadvantage. It wastes your money, consumes your time, and drains your emotions. This is not what a rational investor should do. So who are the people pushing you to trade more? Exactly the people who profit from your trading. They don't care whether you make money or lose money. They only care that you keep trading. Every day you open those apps, all you see is this stock hit limit up. That sector is moving, exclusive insider news. Get in now or miss out. They bombard you with information, create the illusion that making money is easy, and trigger your greed, your luck chasing instinct, and your jealousy. They push you into action anxiety, they keep you trading, and they make you feel like you're being productive. But in the end, your activity simply turns into their advertising revenue and sales commissions. That is the bias built into the whole chain. Now, does trading itself have value? Of course. In 1602, the Dutch East India Company invented the joint stock system. It raised capital that was previously impossible to raise, spread risks that couldn't be spread before, and made possible things that couldn't be done before. Division of labor and exchange are foundations of modern economics. No question about that. But here's where something interesting happens. Securitization was created to solve problems. Over time, it also became a new problem. While still creating value, it began to inflate itself and extract value to the maximum. This is similar to the agency problem. And philosophically, many things in this world seem to carry a kind of deep negative feedback. Once something is created, its development no longer follows the original creator's intentions. And once it passes a certain limit, its negative side becomes the main force. A good thing turns into a bad thing. Take consumerism. Consumption was meant to satisfy our needs and bring happiness, but excessive consumption becomes a kind of trap, and in the end, it makes us less happy. Many things in the world work this way. But let's return to Buffett. His core position is simple: hold for the long term. Don't keep switching. Have the patience to wait for a company's intrinsic value to be released over time.
One of your investments has reached its full potential. As you said earlier, that you
Reach its full potential. Well, ideally, you buy in businesses where you feel that will never happen. I don't buy Coke with the idea that it's going to be out of gas in 10 years, or 15 years. There could be something happen, but I would think the chances of that are almost nil. So what we really want to do is buy businesses that we would be happy to own forever. It's the same way I feel about people who buy Berkshire. I want people to buy Berkshire that plan to hold it forever. They may not for one reason or another, but I want them at the time they buy it to think they are buying a business that they're going to own forever. And I don't say that's the only way to buy things. It's just that that's the group I want to have join me, because I don't want to have a changing group all the time. I measure Berkshire by how little activity there is in it. If I had a church and I was the preacher and half the congregation left every Sunday, I wouldn't say, oh, this is marvelous because I have all this liquidity among my members, There's terrific turnover, I would rather get a church where all the seats are filled, every Sunday by the same people. Well, that's the way we look at the businesses we buy. We want to buy something that we're really happy to own virtually forever, and we can't find a lot of those. We never buy something with a price target in mind. I mean, we never buy something at 30 saying if it goes to 40, we'll sell it, or 50 or 60 or 100. We just don't do it that way any more than when we buy a private business like See's Candy for $25 million, we don't say to ourselves, if we ever got an offer of $50 million for this business, we'd sell it. That's just not the way to look at a business. The way to look at a business is this going to keep producing more and more and more money over time? And if the answer to that is yes, you don't need to ask any more questions.
So the ideal, Buffett says, is to never sell. The company's intrinsic value is never truly exhausted. That is one of the reasons you chose it in the first place. Now, many people hear this and immediately switch off. To ordinary people, Buffett can seem unrealistic. He buys and never sells, enjoying the growth of paper wealth without realizing gains. That feels hard to relate to. But what he means by long-term holding is not just the literal meaning. It is not a rigid rule. It is a mindset. Before you invest, you analyze and choose with the attitude that you do not intend to sell. First, look far ahead. Second, look deeply. Focus intensely on the company's value, and once you buy, hold it with a calm state of mind. Don't be disturbed by short-term information. Don't forget why you chose it in the first place. I'll use the same analogy as the previous video. Value investing is very similar to choosing a life partner. Obviously, you marry someone you're willing to spend your whole life with. So before you commit, you look very carefully at that person's character, values, and personality. You look far and deep. And once you choose, you commit with a long-term mindset. You work on the choice you made. You don't change it lightly. But does that mean you never divorce? Of course not. If something fundamental changes, this person is no longer who you thought they were, or you realize you misjudged them, then you should choose again. So Buffett does not set a take-profit line. He does not say, if it rises 50%, I sell. He does not set a stop-loss line. He does not say, if it falls 30%, I sell. Whether he is making or losing money at the moment of sale is not the key point. The most important question is, based on the company's intrinsic value, is it still worth holding for the long term? The long-termism Buffett advocates is a mindset and a way of thinking. It makes you focus on essence rather than surface, on the long term rather than the short term. It keeps your mind steady instead of anxious over short-term gains and losses. And this mindset is just as useful for young people in work or entrepreneurship. Be serious and demanding when choosing the field you want to enter. Look far and look deep. Is this a long slope with thick snow on it? Be honest with yourself. What do I really like? What am I actually good at? Am I willing to spend 10 years going deep in this field? Knowing the road ahead will be hard. Am I still willing to do it? Once you choose, quiet down and go deep. Stay focused. Push toward excellence. If one day the environment changes and you need to switch tracks, that is fine. You don't need to be dogmatic, but ask yourself again, am I willing to spend another 10 years on this? Long-termism does not guarantee the success you want. It does not guarantee you will beat others at any particular stage, but it reduces a huge amount of meaningless hesitation and internal friction. And in the long run, it gives us a better chance to stay on a sound path and grow in a healthier way.